Hey, Steve Misener joins me now, certified financial analyst extraordinaire. Steve, welcome back.
Thanks, James. Pleasure to be here.
Steve, I think we'll delve right into one of your areas of expertise. German bond yields went negative. Now there's over $10 trillion in debt that yields negatively. What does this portend for the greater economy, and what other currencies might soon follow?
Well, the 10 trillion, I believe, is an aggregate of global currencies, because the Swiss has been negative for quite a while. I mean, the Swiss is one of the most prudently managed currencies in the world, and just for the viewers, so they understand what negative means, it means that you give them $100, you buy T-bills for $100, and you get back less than $100 in 3 or 6 or 9 months, which is an incredible perspective, but it just shows the security associated with that particular currency, or the hardness of that currency versus other currencies which tend to inflate.
Right. So I mean, this is the thing. What kind of individual or what kind of institution says, here, I'll give you $10 and I'm fine with you giving me back $9.80?
Well, they view that the currency is going to be the security versus maybe a decline in other currencies. And that's really, it isn't just the interest rate, it's holding that particular currency versus other currencies. And remember, all currency investments are all relative, even if we treat gold as a currency, as some people do. But it's, do I want to hold US dollars? Do I want to hold Japanese yen? Do I want to hold euros? And it's always a relative thing, and where you're going to be. And people that hold short-term investments, even large institutions holding that aggregate of $10 trillion, they're about parking cash or sitting on the sidelines because they don't want to hold other things at that moment. So it does kind of boggle the mind that someone would be agreeable to take less back, even a small haircut, after a few months. But that's because they believe that that currency, and the market is saying that that currency is the strongest versus other currencies.
Okay.
And even interestingly, the Australian bond, which has always had high yields for decades, the Australian market always had high yields. The 10-year government bond in Australia hit an all-time low at about 1.75%, and that is an incredible story, and reflects the global aggregate support in the bond market in general.
Sure. Does this in any way equate or translate to a situation where it's better to deploy capital and get a guaranteed loss, knowing that the loss is finite and predictable, than it is of taking the risk of deploying the same amount of capital into economic growth, an investment in growth in an industry, in a commodity, in a sector, because taking a loss is of a far greater certainty than getting any sort of return from a higher risk investment in the general historic context of what an investment is?
That's a sound analogy, or sound kind of situation that you played out, and it's really about relatively short term. If you put out money for 3 years or 5 years, you are going to start getting those positive yields, even if they're rather skinny. So this is a relatively short-term situation, although...
so this is only short-term money that's getting the discount?
Yeah, because the yield curve typically has this kind of upward trajectory. You commit to debt securities in almost any currency over long periods of time. You're assuming greater risk because of the unknown down the road over multi-years. So you typically, in the market, typically in a normal yield curve trajectory, you get some positive yield. It's just very unusual when the short end dips negative. Now, it is in some models and some history that negative short-term returns can be problematic because they're forecasting much weaker economic growth, and that's where the economists are really trying to tighten their numbers. There's several Fed governors speaking this week, and people will be watching closely to see what their comments are.
Sure. So we saw gold catch a bit of a bid today. Oil is still in the shitta, as they say in the UK, and the S&P is looking awfully shaky and volatile at these again, all-time highs. So do all of these signals, a major G7 currency going negative in the short term, gold catching a bid, oil price is still in the crapper, does all that sort of portend a general broad economic direction that sort of inclines more towards high risk, negative outlook as opposed to a lower risk, positive outlook, like some analysts are saying that, oh no, we've got another 7 years of this bull market?
Well, 7 years would be very optimistic because it's been a long, long bull market of really 10 years to date. It was really March of '09 was the double bottom after the '08 meltdown, if you will. So it's really been 10 years this month that the U.S. markets and global stock markets have been on a rise. But gold, with its rally, remember, gold is by many treated as a currency as much as anything else, whereas oil is a consumable good. So the detachment of oil being weak could reflect a possible a global slowdown of economic growth, whereas gold really is less influenced by economic growth and more by a store of value and as a relative currency to other currencies out there. And as we said on the last time I was on a few weeks back, that China turned the corner in October and November, the first time in several years that they became big net buyers of gold. So people are watching that as possible backing for their currency down the road.
Mm-hmm. You bet. Okay, so where would you be deploying capital now?
Well, I mean, I think that staying a little bit powder dry in cash is okay. I think that we've obviously seen good moves in some of the interest sensitives, but there still are some good values in the Canadian dividend sectors, and I think that probably the U.S. is not going into recession. I think it may be overdone. So there are probably still some areas of good, sound economic growth that's being overemphasized right now. I mean, the labor market's still very strong. It's interesting to note that the Fed was so bearish about and raising rates and so concerned about overheating in the economy with the big 4.2% GDP growth in Q2 last year, but that really was an anomaly. It was going to slow down. So here we have the Fed being aggressive in December, and in April, or in fact March, 3 months later, now they're talking about rate cuts possibly. It's crazy how that turn has happened because they have access to more economic information than anyone on the planet about the U.S. and global economy.
Mm-hmm. Yeah, well, that's confounding. How does Brexit figure into all this? Does anybody care? Does it matter?
It's still a wide unknown, and markets are jittery about that, certainly. This hard Brexit or no Brexit or what's going to happen in the middle, and any time that a major country's government is considered a little bit, I'd say, unstable, only because we don't know the future of the Prime Minister May there at the moment, that creates uncertainty, and people like to back away from that. So I'd say that the unresolved nature of Brexit is probably the more difficult thing in the short term, rather than it going one way or another, being bullish or bearish. Mm-hmm. Because I don't think that the people I've spoken to based in London, they don't believe that banking is going to move to Frankfurt or other locations. It's going to stay in London regardless of whether Brexit or whatever type of Brexit occurs. It's simply a global center of banking, and I don't think that's going to change.
Mm-hmm. What about the issue of the Irish border? I mean, economically, not such a huge contributing factor to the entire European equation. But for me, I look at the political uncertainty that sort of accrues to that question, and I wonder if a lack of a Brexit deal and certainty as to how that border could be treated could reignite some of the conflicts of the era of the Troubles.
I don't believe it would. I mean, I'm not an expert in the field, although I was in both Ireland's Republic and Northern Ireland in June, 8-9 months
Partying
ago.
with Van Morrison, if I recall correctly.
Indeed. But I don't think it would generate those kinds of issues, but certainly from an economics perspective, and more critically is that the Northern Irish parliamentarians who are in the British Parliament have been supporting May's Conservative Tory government, and maintaining that support so that the Tories can stay in power, that's the key. So they have a great deal of bargaining power because of that swing support in propping up the British government. But it is a complicated issue because as of last June, you just drive right through the border, and probably still today, and putting some kind of hard border where Northern Ireland is not part of the EU to some degree under Brexit, and the Irish Republic is, that's certainly problematic for the people of Ireland, and therefore plays into the stability of the Tory government. And but I don't think it would be cause for the kinds of conflicts in the past.
Interesting. Well, I guess we'll have to see how all this plays out. Steve, we're going to leave it there for now. Thanks very much for joining us again.